Lady, gentlemen, thank you for coming.
Thank you.
Chris, can I start with you? And I'll tell you why I want to start with you. Because, yes, Cosatu came up with a statement saying the bank missed an important point where it could have cut interest rates and helped restart growth. But I think broadly, Cosatu is critical of the Reserve Bank's monetary policy stance and the way it has conducted it. Is that justified criticism, given your background within Cosatu?
Yeah, well, it has been a long-standing debate about the need for the central bank to have at least multiple mandates. When it comes to monetary policy, what is often mentioned in Cosatu is that we need a dual mandate where the Reserve Bank looks at employment and inflation. So it's justified. But what we need to be aware of is that the Constitution constrains the Reserve Bank on what it can do, because it clearly states that the primary function of the Reserve Bank is to protect the value of the currency in the interest of balanced growth, balanced economic growth. So the external value of the currency in this instance is of concern to the Reserve Bank, because in my view, had they cut, there was going to be some currency movements which was going to create volatility in the external value of the currency. Okay, I'm going to come back to that. Nicky, I want you to come in as well. It's exactly the same question, but of course, you come from a different environment and background.
Did they miss a trick, is what you're asking?
Essentially, yes. And is it also wrong that the Reserve Bank continues arguing around the fact that its main mandate is to keep inflation low, and some people suggesting that it's ignoring the other mandate, which is part of its mandate, even as currently constructed, of also looking at growth?
Yeah, I was going to say, I mean, its mandate says, containing inflation or, protecting the value of the rand, which is the same thing.
In the interest of balanced growth.
In the interest of balanced growth. All the way to see this is that in a way that, doesn't hurt the economy too much. I mean, there are times where you have to act against inflation, where it will have impact. The whole idea is that it's a transitory impact, it's a short-term impact on economic growth. At the moment, though, we have a situation where inflation is under control. It's certainly, the Reserve Bank has indicated that implicitly, explicitly, they're really trying to sort of aim the vehicle down the middle of the road around that 4.5% level.
On that.
At the moment, inflation at 3.7%, lowest it's been for many, many years. There appears
for 8
to be,
years.
there appears to be absolutely no pressure, demand pressure on prices. And so the key worry really here, it is a big worry, is this complete dramatic deterioration in the fiscal position. The likely impact that will have on capital flows when it finally starts to be reflected in the ratings situation. So that's the worry. That's what's holding them back, I think, primarily. But then they say themselves that the QPM suggests 2020 third quarter that there is scope for a cut. Will it have stimulated the economy that much? Listen, it would have greased the wheels a bit, but taken away a bit of the squeak as the wheels turn, but it wouldn't have made them turn faster.
Don't we need every squeak that we can get?
It won't make them turn faster. It's a
Is the Reserve Bank trying to compensate for what many have suggested last year, November, this time, was a mistake in hiking?
Yeah, there we definitely would have agreed it is a mistake. This time around, we do think they may be a bit overly cautious, but we also buy the argument that their ability to actually stimulate this economy is very limited. And in fact, if you look at graphs going back, and you look at our historical patterns, that's what we've relied on. We're always pushing demand, whether it is through government growing the public service and paying them very handsome above inflation wage increases, or whether it's through interest rates. That is what we rely on. It's the other part of the element, the other element of growth, the key ingredient, which is fixed investment in capacity and productive capacity, that is missing. And unfortunately, cutting rates 25 basis points is neither here or there in terms of getting fixed investment activity going.
Maybe you cut by 1 full percentage point, maybe that will jolt it and it will give it a bigger squeak going forward. Chris, is that an argument that you buy? Interest rates won't change anything?
Yeah, because, in the context where there is deep disinflationary pressures coming from shortage in demand, interest rates have got limited impact. I mean, the role of interest rates, according to me, is to change the valuation of assets and prospects for investment. But if the expected cash flows from investment are dim, even if you cut interest rates, your discount factor is not going to have that much of an effect on the asset valuation. So the big thing here is demand, the demand side of the economy.
And therefore we should be talking about structural reforms that the government ought to be implementing, etc., etc.
No, I don't buy that.
What do you buy?
I believe that the government needs to spend and boost aggregate demand, because as we speak, we know that there's a shortage in demand.
She's looking at you.
There's no capacity problem. There's a shortage in demand, hence disinflationary pressures. Otherwise, why would there be disinflationary pressures if we've got capacity problems?
Right.
You see, so there's a negative output gap out there.
Indeed, there is.
Yeah. So therefore, we need a government to push infrastructure. To push the delivery of basic services, to boost aggregate demand, and to make sure that the spending is localized. So
if you were looking at the Reserve Bank, if you were sitting in the chair of the Reserve Bank and you were the Monetary Policy Committee, what would you have done?
I would not have cut interest rates because it's going to upset the currency. I would have used other instruments, for example, credit. I would have opened a window for development finance institutions to come to approach the Reserve Bank and to get funding so that they can stimulate economic activity. I would have been offered, even the finance minister, an option to say, I can give you credit at a lower interest rate to push infrastructure, so that in a way that does not put pressure on debt. You know, we need a different way of financing development in South Africa. That has always been my argument.
Okay.
Yeah, listen, that's more of the same though. We've tried that trick in many, many ways. We've done nothing other than allow government spending to grow. In theory, Eskom and many of the state-owned enterprises have been doing nothing other than investing in capacity. But the truth of the matter is there is spare capacity in some sectors. But those essential capacity you need, like electricity, which is not a luxury, it's an essential. In order to expand your operations, in order to operate effectively, the cost of electricity since 2007 has increased by over 350% in nominal terms, over 150% in real terms. So that goes into your investment picture. And then, you know, the availability of electricity. Eskom today produces less electricity than it did in 2004. So how you can say capacity is not a problem is a little bit of a strange argument for me, because it is very clearly a problem. And it really ties the hands of the private sector. If you cannot get access to reliable and cost-effective power, how are you supposed to expand your operations?
Yeah, he wants to respond.
But there's excess capacity in power stations. We know that.
I know that is not true.
Okay. We hold different views on that, but there's excess capacity in power stations. And what I can say is that as long as the economy is slack, of course you'll have your power utility underutilizing capacity. Of course you'll have your average cost of producing electricity being high because you're underutilizing capacity. Already, you know, one of the drivers of the price of electricity, we know that it's not necessarily Eskom being inefficient, it's because of coal prices. We know that. So we need to disentangle these things and start a narrative that is more...
Okay, that's a very interesting one, because I want to say, why introduce load shedding if you have spare capacity? It is the bizarrest argument I've ever heard. I just don't understand it. You'll have to explain it.
The time is not with us, so we'll have to redo this argument again. But since I've got you two heads here with me today, I wanted you to tackle one other issue I've had with the Reserve Bank for a while. The issue of moving the target for monetary policy effectively from a range of 3 to 6% to 4.5%. How does that work? Is that correct? Is that allowed?
Well, 4.5% is the midpoint.
Yes.
So that's what actually they are targeting.
No. If I remember, the Constitution says it's the mandate says it's 3 to 6%.
Yes, but remember that in targeting inflation, there's volatility. So the central bank gives itself a give and take, you know. So in fact, the lecture by the governor of the Reserve Bank makes it very clear that their actual target is 4.5.
Yes.
The upper
Whereas
bound,
the other governors were talking 3 to 6%, and we lived very comfortably within our 3 to 6%. We were not being constrained into this 4.5%.
You know, they have now got the quarterly projection model, which you can't put in a range of 3 to 6%.
Yes.
You can build an uncertainty around it.
So we've given it up to the machine. AI is already here before we get it.
Not the machine. They say that it is, not not depriving them of their judgment, and I believe them. You know, it is another indicator of and it's attempting to be an objective indicator. So I don't think the 4.5% is cast in stone. But I think you'll often...
Is it not costing us growth jobs?
No, I don't think so. Again, if you want growth jobs, you need fixed investment. A company will not employ more people unless they need more people. And if they're not going to expand their operations, why would they need more people?
Chris, old argument. Developing economy like South Africa needs a little bit of heat in its system to be able to grow and can take 6% inflation.
Yeah, that's correct. But in my view, I think if we're developmental about it, we need to ensure that the types of inflation that are coming through should not be inflation that affect the poor. For example, we need to have a means of controlling food inflation. The other inflation can go crazy, but the food inflation that affects the poor should be controlled. I mean, that has been a strategy. Even today, as we speak, in Southeast Asia, they control food prices. But South Africa is the only country that wants to grow very fast, but at the same time, it wants a complete free market system to operate. I mean, it's not going to work. There needs to be some...
Quick rejoinder.
Sorry?
Quick rejoinder, you want to
No, I mean, obviously I can't agree with the idea of letting inflation go crazy.
Not go crazy.
No.
Yeah, I mean, he's saying contain food inflation, but don't worry about the rest. I mean, I think it all comes back to the consumer at the end of the day.
Yes.
And the bulk of South African consumers are poor.
So we all agree that really this animal lies at the hands of the government. It is the government that needs to show leadership here. The bank has done the best that it can.
I think so.
Yeah.
Okay, we need to shoot the government. Thank you, ladies and gentlemen. Chris Malikane, Associate Professor, Economics at UNIS. I was going to say UNIS, I wanted to say WITS. And Nicky Weimer, Economist at Nedbank. Thank you for coming in, guys.